we will explore ways that cost information can be used to make short-term strategic decisions. Part A focuses on making pricing decisions. At what price should we sell our products? In order to understand this, we need to talk first about different types of costs. Some costs are relevant. That means that these costs make a difference to our decision at hand. They're also called differential costs because a relevant cost will be different depending on which decision we make. Obviously, any cost that will be the same no matter which decision we make is not relevant for that choice. Another issue is avoidable costs versus unavoidable costs. An avoidable cost will be there if we make one decision, but we won't have that cost if we make a different decision. By contrast, unavoidable costs will be there regardless of which decision we make. Therefore, avoidable costs are always relevant because they're always going to be different depending on which decision we make. Whereas unavoidable costs do not have to be considered in the decision at hand because those costs will be there regardless of which option we choose. Another issue is opportunity costs versus sunk costs. An opportunity cost, if you remember from a previous discussion, represents what we give up in our second best choice by selecting what we perceive to be our best choice. And opportunity costs are always relevant even though managers sometimes don't pay enough attention to them. By contrast, sunk costs have already occurred. There is no decision in the present that can affect them because they've already happened. Because of that, opportunity costs are always relevant. What we give up depends on what we choose, whereas sunk costs can't be differential costs because they've already happened. Nothing now can make them be different. So, the basic procedure is to estimate all of the relevant revenues and costs for each of your options, and then compare these options to your current status. And always consider qualitative issues, that is, factors that may influence you to choose an option even if it doesn't have the most economically favorable combination of revenues and costs. Remember, numbers advise us, but they don't rule us. We get to make decisions. We get to evaluate all factors, even factors that don't show up well mathematically. Finally, based on all of the issues, choose the best option. So, what if we are trying to decide how much to charge for our product? Generally, prices are based on supply and demand. The more providers there are, the harder it's going to be for us to charge a high price. The more demand there is for our product, the easier it is to charge a high price. And pricing helps us to decide which of our products will be the most profitable for us. One way to think about pricing is to consider full cost. We discussed this concept in a previous chapter, and we said that it includes all costs involved in making and selling a unit. That would include all of the production costs, the marketing and administrative costs. Ultimately, in general, our product prices must cover all of the costs that we incur, or we can't be profitable. So we need to consider the variable costs for each unit, and we also need to consider all of the firm's fixed costs. From cost volume profit analysis, we know that the full cost per unit would equal the fixed costs of the firm divided by X, the number of units that we make and sell. That would be the allocated fixed cost per unit plus the variable cost per unit. In the long term, our selling price must cover full cost. However, in the short term, using full cost leads to what's called the full cost fallacy. That means in the short term, our fixed costs are going to be what they are. So a short-term decision to sell a few more units or a few less units will not affect fixed cost, and we do not have to allocate fixed cost to those short-term units if we don't want to, because if we say no to making and selling those units, our fixed costs will still be the same. Remember, an allocated fixed cost is not the same as a variable cost. The more units that we make and sell, the less of our fixed cost each unit has to carry. So let's look at an example. Glassys makes windows that construction contractors use in their projects. We're told that they have the ability to make 10,000 units in a period, but currently they're only selling 8,000 units. We know the selling price, we know the fixed and variable manufacturing costs, and the fixed and variable selling and administrative costs. Now, a contractor makes an offer. The contractor wants to buy 1,500 windows from Glassys at a price of $165 per unit. This is significantly lower than the firm's normal price of $220 per unit. In this case, instead of charging a per window commission, the contractor would be willing to pay a flat fee of $12,000 for this special order. A special order always means an order at a special price, by which the customer means lower than the normal price. In this case, fixed costs are not affected by the decision, so the question is, should Glassys accept the special order? In order to make this decision, we need a decision rule. Generally speaking, as long as a firm has excess capacity, that means that accepting a special order at a lower price would not affect all of the firm's regular customers. So in that case, as long as the revenue from the special order is greater than or equal to the variable cost of the special order, then the firm should say yes, they should accept the order because their fixed costs are not affected. And the larger the revenue is compared to the variable cost, the more attractive the special order would be. However, if the revenue from the special order is smaller than the variable cost of the special order, the firm would want to reject the order because they would lose money. Each unit would not even cover the variable cost of its production. On the other hand, if a firm does not have excess capacity, that means it will have to give up some regular sales in order to say yes to the special order. That makes the special order much less attractive for two reasons. Number one, it means that the firm will have to say no to someone that they expect to continue doing business with. That's not usually a good strategy. In addition, they're giving up the profit that they would normally make on sales to regular customers. In that case, in terms of dollars and dollars alone, the firm should accept the special order only if the revenues from that order cover the variable cost of the order and the opportunity cost, the profit from the orders that the firm gives up, because it won't be able to fulfill some of its regular sales. But as always, these decision rules are only guidelines. After we've taken a look at what the dollars tell us, then we need to think about whether there are any qualitative considerations, non-mathematical issues that would make us choose differently. And we'll talk about that as we go along. So, in a differential analysis, remember we only consider the things that are going to be different, because obviously anything that's going to be the same is not relevant for the decision. So in this case, the differential sales revenue is going to be the special order amount, 1,500 windows, times the special order price, $165. The variable manufacturing cost of the special order is going to be the 1,500 windows times the firm's own variable manufacturing cost, which we were told was $150. The selling and administrative on this special order is not going to be a per unit fee. The contract says it's going to be $12,000 fixed. So now that means, based on dollars, this special order gives the firm a net profit of $10,500. So it should accept the order, right? I don't know. It definitely generates profit. So based on money alone, the firm would want to say yes to this special order. However, there may be qualitative reasons for the firm to say no. For example, the firm's other customers might not be very happy if they find out that this customer got a better price than they did. And we certainly don't want to offend our regular customers. Often special orders are requested because there's a special reason. For example, these windows might be used in a building designed to house the homeless. Another possible qualitative consideration is variability in our orders. If we accept the special order and then a large order comes in from one of our regular customers, we might not be able to fill it. The point about qualitative considerations is not that they tell you the answer, but that they give you additional issues to consider before you make your decision. Now let's look at a slightly different scenario. For example, supposing the contractor wanted to buy 2,500 windows instead of 1,500 windows at the special price. Should Glass Ease accept the special order? Well, that's a problem because the firm's production capacity is 10,000 units, but they're already scheduled to make 8,000 units for their regular customers. That means that they only have excess capacity of 2,000 units. Well, if they accept the special order for 2,500 units, they would have to give up 500 units of their regular customers' work. So, in order to accept the special order, the firm would have to give up 500 of its regular customers' units, and that represents an opportunity cost. So let's see how that plays into our analysis. The contribution margin on a regular window is the difference between its selling price and its variable cost. In this case, windows usually sell for $220 minus their variable manufacturing, minus their variable selling and administrative, means the contribution margin is $58. On a special order, the selling price is $165. Variable manufacturing hasn't changed, but remember, in this particular situation, we were told there was no variable selling and administrative. That was treated as a fixed cost. So net, the contribution margin is $15 per window. That means that if we accept the special order, we're going to get 2,500 windows with a contribution margin of $15 each, but we're going to give up 500 units with a contribution margin of $58 each. And in addition, we're going to incur our $12,000 of fixed selling and administrative on the special order. Net, that means saying yes to the special order would end up costing us $3,500. So, on the basis of dollars and dollars alone, we would probably say no to the special order, since it will absolutely decrease our profit, and in addition, we might offend one or more of our regular customers. However, we always need to consider qualitative factors. In other words, is there some reason that we might be willing to give up $3,500 of profit? If there is, there's nothing stopping us from saying yes to the special order. For example, we might have strong feelings about housing for the homeless, or we might hope that in the future, if we give excellent service to this new customer, they might become a regular customer. Let's talk a little bit more about pricing. There are two ways to think about pricing: long-term and short-term. Generally, the first thing that we think about when we set our price is how much does it cost to provide the product or the service. In the long term, we already said we need to cover full costs. That means not just manufacturing costs, but also selling and administrative costs. However, in the short term, since our fixed costs are fixed, we only need to cover our variable costs. Another way to think about pricing is life cycle pricing and life cycle costing. We know that there are other parts of the value chain that may occur before the product was ever designed and made, or may occur after the product has been sold to the customer. Before production, we have research and development and design and setting up our supply chain. Then we get into production. Then we have to market our product, sell our product, distribute our product, service our product, and depending on what we make, have disposal costs at the end of the product's life. All of these must be covered. So when we're making a pricing decision, we need to think not just about how much it's going to cost in the current period to make and sell our product. We also need to think about how long that product is going to last, so that we can spread out these life cycle costs over the revenues that we make during the period of time when our product is marketable. Another issue is target pricing and target costing. Most firms are price takers. That means that they operate in a competitive market, and it is the market itself, not the individual firms, that sets the price. Because of that, the firm's target price is going to be based on the competitors' prices and whether customers perceive any extra value in our product's particular combination of benefits. Once the firm has determined its target price, it needs to consider how much profit it would like to make from selling this unit. The difference between the target price and the desired profit represents the target cost, the maximum amount that a firm can spend to provide this product. Now the firm's question is how to achieve that target cost. What can we do if the product is currently costing us more than that amount? Well, one possibility is to accept a smaller profit margin on each unit that we sell. Most firms don't like that, so instead they look for ways to reduce the cost of the product, either by redesigning it or by finding other sources for labor and materials, or by leaving out functionalities that the firm feels customers might not care about. Target costing is a very competitive activity. There are also some legal issues associated with pricing. One is predatory pricing. The idea here is that a firm will temporarily choose to sell its product significantly below the amount that its competitors are selling similar products. In that case, this firm hopes that it will be able to drive out competitors. They won't be able to offer as low a price. Customers will flow to the predatory firm and the competitors will go away. Once they do, then this firm can raise its prices again. Generally speaking, predatory pricing is illegal. It violates antitrust laws. And the general rule that's used to test whether a firm is engaging in predatory pricing is whether they are selling their goods at less than the average variable cost for those goods. If they are, then it's presumed that they are engaged in predatory pricing. Dumping is a similar strategy on an international level. In dumping, one country exports its products to another country at a price that is lower than what that country can provide domestically. The main strategy that's used against dumping is tariffs, that is, taxes on imported goods, which will bring the cost of the imported goods up to or above the cost of similar domestic goods. Another issue is price discrimination, that is, selling the same goods at different prices in different markets. This strategy only works if a firm is able to segment its markets. That means prevent customers from buying the goods in the cheaper market. For example, a well-known women's clothing catalog was sued several years ago when it was discovered that the company was selling the exact same goods to customers at significantly different prices. Not surprisingly, the firm was charging very high prices in highly populated cities in California, in Chicago, in New York, and lower prices in other areas. Now, price discrimination is different from price sensitivity, which means whether customers will stop buying a product if it's more expensive. For example, gasoline is much more expensive in New York than it is in New Jersey. However, that is considered acceptable. Another issue is peak load pricing. This is perfectly legitimate. It means setting higher prices when demand is higher. So, for example, during the summer, electric companies sometimes charge a higher rate for electricity between 9 and 5 than they do the rest of the day. If you don't want to pay the higher price, don't turn on your air conditioner when demand is high. One more issue is price fixing, which means colluding with other suppliers to set a price at a particular level. This is not legal, but it is extremely difficult to prove. For example, if you've ever seen a corner with several gas stations, it's not surprising to find that all of the gas stations are charging exactly the same price per gallon.